China's economic growth has been making headlines, and this time, the world's second largest economy has entered into deflationary territory again. According to the data released by the National Bureau of Statistics, China Consumer Price Index dropped 0.2% in October on a year-over-year basis, re-entering into a state of deflation. Now, after slipping into deflation previously in July, it recovered to positive territory in August and hovered around near zero in the last 2 months. Now, to add to this, the Producers' Price Index also fell for the 13th straight month, dropping 2.6%. The deflationary trend in China is attributed to a combination of factors. Number one is the weak consumer demand. Chinese consumers are reluctant to make big ticket purchases amid a slowing economy and rising concerns about job security. This lack of demand is driving down prices. Interestingly, pork, which is the main food item among Chinese, fell 30.1% and was one of the main contributors to the deflation in the country. Now, China's real estate sector, which is a key driver of economic growth, is in a prolonged slump. With declining property prices and tighter mortgage regulations, home buyers are hesitant to enter the market, further reducing overall consumption. Now, to add to this, the global economic slowdown is also taking a toll on China's exports, which fell 6.4% on a yearly basis, indicating a reduced demand for Chinese-made goods. Now, while other economies are fighting with crippling inflation, China has entered into a deflation. China's economic growth post-pandemic has been much slower than expected. Now, China's role as the world's manufacturing hub has been undoubtedly monumental, with many countries relying on its capabilities for production and trade. However, the recent slowdown in China's economy raises concerns not only for the country itself but also for the global economy. Now, despite all of these concerns, China is still expected to grow at a healthy rate of 5.2%, while the global economy grows at 2.9% for the full year of 2023. But declining exports, a downturn in the property sector, and high unemployment rates all point to issues that may be impacting China's growth. Crude oil prices are a significant factor influencing economies around the world. Any increase has an impact on the financial markets as a whole because it usually results in increased prices for consumers and businesses. Now, a number of factors affect the price of oil, starting with the well-known forces of supply and demand, geopolitical incidents such as the Israel and Hamas war or the Russia-Ukraine war, and also global macroeconomic conditions. As seen in the last 2 years, oil prices can rise as quickly as they can fall, both unexpectedly and abruptly. Last year, due to Russia-Ukraine war, oil prices rose to more than $120 per barrel. These high energy prices caused massive inflation across economies and prompted the central banks to hike interest rates. Now, on the back of high interest rates, fears of slowing economic growth emerged. This year, oil prices fell to $90 per barrel. On weak demand concerns due to global growth slowing, it later fell to $70 per barrel. Now, naturally, this led to major oil-producing countries to reduce their output in an attempt to drive up prices. Then the Israel-Hamas conflict and speculations regarding Iran's involvement further led to the rise in crude oil prices. Now, when tensions arise in oil-producing regions, it can lead to problems with crude oil supplies, which leads to a rise in oil prices. But now, crude oil prices are pressured on the downside once again. Oil prices fell to their lowest in over 3 months due to a substantial rise in US crude inventories and mixed Chinese economic data that pointed to muted demand for oil. Now, we see how volatile crude oil prices can be, with many factors contributing to the fluctuations both on the upside and downside. Now, but with crude oil prices around $80 per barrel, the market is clearly less concerned about the potential for Middle Eastern supply disruptions and more concerned on the demand side. So what does this mean for India? A drop in crude oil prices is positive for India because it imports the majority of the oil it needs, and a rise in oil prices increases India's import bill, which leads to a further increase in the country's current account deficit and puts pressure on the Indian rupee. Now, it also translates into higher costs for our businesses, eating up their margins. Now, while it is good news for India, crude oil prices are expected to remain volatile as there are a number of factors at play which are feeding into a highly uncertain outlook. Having said that, this is me, Merlin Susanna, signing off. Take care and stay invested.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com